In the world of finance, the weather can change in a heartbeat. One minute it's calm, the next, interest rates are spiking, currencies are all over the place, and stock markets are taking a nosedive. For a bank, trying to navigate this isn't just about making money, it's literally about survival. So, that brings up the big question, right? How do they actually do it? How does a bank chart a course through all that financial chaos to protect not just itself, but really the entire economic system that we all rely on? Well, the answer comes down to mastering something called market risk. So, what exactly is market risk? Well, think of a bank as a giant ship on the ocean. Market risk is all the unpredictable weather. It's the sudden squalls, the giant waves, the thick fog. It's the very real danger that a bank's investments could get hammered by forces completely outside of its control. To really get a handle on how banks stay afloat, we're going to walk through the official guidance from the Reserve Bank of India. We'll look at their blueprint for controlling risk, figure out who's at the helm, look at the specific storms they're watching for, and then most importantly, why any of this matters to the rest of us. Okay, so every good ship needs a solid design, a blueprint. For a bank, that blueprint is its risk management framework. This is the detailed plan for ensuring the ship stays safe and stable, no matter how rough the seas get. And at the heart of this blueprint is a 5-step process. You can think of it like the captain's essential safety checklist. It's what they do before and during any voyage. It all starts with identifying the dangers and ends with reporting everything back up the chain of command. So, let's break these down. First things first, you can't manage a risk you haven't identified. It's that simple. Before a bank can even think about trading a financial product, it has to be fully documented in what's called a product program. This is basically the ship's operating manual. It details exactly how to handle every single piece of cargo, what the dangers are, and what to do in an emergency. Absolutely nothing gets on board without a plan. Okay, next you set the boundaries. A bank has to establish hard, mandatory limits on how much risk it's willing to take. And this is where it gets really interesting, with this idea of a stop-loss trigger. This is like an automatic alarm that goes off if a trading position starts losing too much money. It forces everyone to stop and reassess. It's the circuit breaker, designed to stop a small problem from turning into an absolute catastrophe. So once the ship is sailing, you have to be constantly checking the instruments. Banks are required to value their trading positions every single day using real live market prices. And this is crucial. Those prices have to be checked by someone independent. On top of that, they run these stress tests, basically running simulations of a financial hurricane just to see if the ship would hold up. Now, this point is so important. Your navigation tools have to be perfect. Banks use these incredibly complex financial models to figure out how much risk they're in. But you can't just take them at face value. Regulators demand that these models get independently tested and certified. I mean, you wouldn't try to navigate a storm with a broken compass, right? Same idea here. And finally, step 5, communication. All of this amazing data has to flow up to senior management in reports that are clear, quick, and to the point. A report that just dumps a bunch of numbers is totally useless. It needs written commentary that actually explains what's going on and highlights the biggest risks. That's what allows the leadership to make smart decisions fast. All right, so we've got the blueprint. Now let's talk about the crew. An effective risk framework is nothing without a clear and solid chain of command, where everyone knows exactly what they're responsible for. Right at the very top, you have the board of directors. These are the admirals of the fleet. They aren't steering the ship day to day, but they're the ones who set the overall strategy, who decide how much risk the bank is willing to take on in the first place. The buck ultimately stops with them. Reporting directly to the board is the Risk Management Committee. This is a high-level group that takes the board's big picture strategy and turns it into specific, concrete policies. They're the ones who officially sign off on those risk limits and stop-loss triggers we were just talking about. Next up is the ALCO, or the Asset Liability Committee. This is the ship's bridge, the operational heart of risk management. It's usually headed by the CEO, and this is where the senior officers are making real-time decisions, steering the bank's balance sheet, and making sure the whole operation stays on the course set by the board. And this brings us to one of the most critical concepts in all of risk management, the middle office. This is a group of specialists that has to be completely independent. Their only job is to measure and monitor risk. They don't trade, they don't take positions. They are the bank's internal watchdog, and they make sure everybody else is playing by the rules. This slide just captures that separation perfectly. On one side, you have the dealing room, the engine of the ship, trying to generate profit. And on the other, you have the middle and back offices, the navigators, whose only job is to ensure safety and compliance. When that separation breaks down, you get disasters. It's how one trader, Nick Leeson, was able to hide over $1 billion in losses and single-handedly bring down a 233-year-old bank. The lesson is crystal clear. You never, ever want the engine room to be in charge of steering the ship. So, what specific kinds of financial weather is this whole system actually designed to handle? Well, the framework really zooms in on controlling a few key types of market risk that could easily capsize a bank if they're not managed properly. First, and probably most important, is liquidity risk. This is basically the financial equivalent of your ship running out of fuel in the middle of the ocean. It's the risk that a bank just runs out of ready cash to pay its bills. Even if all its long-term investments are solid, if it can't make payroll tomorrow, it's in big trouble. A lack of liquidity is one of the fastest ways a bank can fail. Next, there's interest rate risk. See, banks make money on the spread, the difference between the interest they earn from loans and the interest they pay out to depositors. If market rates suddenly shift, that spread can shrink or even go negative, which hurts profits today and can wreck the long-term value of the whole bank. And of course, for any bank that operates globally, there's foreign exchange risk. If you hold a bunch of assets in one currency, but you owe money in another currency, a big swing in the exchange rate can cause absolutely massive losses. It's like navigating in waters where the currents are constantly and unpredictably changing direction on you. So we've seen the blueprints, we've met the crew, we've identified the storms. But why is this framework so incredibly important? Well, the impact goes way beyond the balance sheet of just one bank. And really, this is the ultimate takeaway. A strong market risk framework doesn't just protect one institution, because all these banks are so interconnected. The failure of one can start a domino effect that ripples through the entire economy. So making sure each individual ship is seaworthy is critical to preventing the whole fleet from sinking. This quote from the Reserve Bank of India really says it all. This stuff isn't just a task for the math geniuses in the back office. The ultimate responsibility for managing market risk lies at the very, very top. It has to be a central, major concern for the CEO and the board of directors. And that leaves us with a final thought. The financial world never, ever stands still. New technologies, new products, new kinds of risk are popping up all the time. So the question we're left with is this. As the weather patterns of the market keep changing, what's the next perfect storm that this framework is going to have to evolve to handle?